Most business owners think that tax savings comes from one big write-off. Although that might be true, in reality, the biggest tax savings comes from stacking different deductions that are ordinary and necessary for your business. Bookkeeping, people, it's the foundation, baby. And guess what? Almost no one does it correctly, but let's go over how to do it. What's up, guys? Mike back at it again, CPA, co-founder of Ledgerly, alongside my partner in crime, Andrew D'Amico, giving you the latest and greatest when it comes to strategy, foundational, operational, all things business. So make sure you hit that subscribe button for videos just like this one. All right, let's zoom out for a sec. We see this over and over again all the time. Business owners aren't overpaying on their taxes because of a lack of deductions. They're overpaying on their taxes because they don't structure their deductions properly. And at the end of the year, they're scrambling to go through their personal bank accounts. Oh my God, don't go through your personal bank accounts. If you have a business, you have a business bank account. But they're going through their personal bank accounts, highlighting in different color highlighters, 5 different color highlighters for gas. This one is travel. This one is meals. This one, stop. Just stop that. Like that old comedy skit. Stop it. If you're a business, you operate as a business. So this video is on stacking deductions, how to do it properly. That's repeatable, defensible, and a system that works throughout the entire year so you're not scrambling at year end just to file your freaking tax return. And here's the issue with most deduction advice, people, is that it's presented as a list. So we got a list. We got home office, we got auto, we got phone, meals at 50%, software, etc. However, this list is not strategy. This list doesn't say how to track it. How do you track your home office? How do you track your auto? How do you track your phone? How do you track your meals? How do you track your software? This is not strategy. Instead, it's more of a trivia game. It's more you got these blank spaces over here, okay? And then we need to match up the right spaces. Remember this game? It's like, oh, which one goes with this one? You know that whole thing? Let's stop guessing. This ain't guess who. This ain't, hey, does your guy have glasses and is bald? Well, it's probably Mike from Ledgerly. But it's not a game of guess who. This should be something that you know and you're confident about. It's reliable and defensible. It's ordinary and necessary. Deductions aren't rocket science. When they're layered on correctly, they win. But without the proper structure and technique in place, it's like putting up a sign for your lost dog. You have no clue where they are and how to find them. And let's not be paying a finder's fee to the IRS. So let's go through this. Come on. Here's the framework. We got 3 layers here, right? So our first layer here is our foundational expenses. Now, you know what? Before we even do that, I want to draw another box down here right below foundational, and this is bookkeeping, maybe with QuickBooks Online. That is our first foundation. And you know, we always harness on this because guess what? I guess we'll get to that. But guess what? See the strategic box here at the top? We can't do that without bookkeeping. And you know, we always pound this one to death. So bookkeeping is number 1. Now, layer 1 as far as this, but layer really 2 is the foundational expenses. What are those foundational expenses? These are your unavoidable costs of operating, your fixed costs, whether you're a service business, you're a goods business, the things that you need in order to operate and run your business. Operation was number 2, but your foundational ones. Now, guess what? All businesses are different. But for example, we're probably gonna have a software, we're gonna have professional service fees, we're gonna have insurance, maybe there's some educational purposes in there, like continuing education, supplies, cost of materials. So our foundational expenses, let's call these our fixed expenses. Now, our operational deductions. This is where it gets very inconsistent. These are our home office, our auto deductions, our phone, our internet, personal expenses tied to business purposes. These can be variable. And guess what? These need the right documentation. These need to be consistent. And there needs to be some external tracking. Maybe it's not just on your business set of books. Maybe you have an outside set of books, the accountable plan people. You have the accountable plan that you're tracking these operational type expenses. Like me right now, I'm filming this video in my home office. Every month when I'm going to pay my bills, pay my mortgage, I have my accountable plan spreadsheet. I put my mortgage payment in there. What were the taxes? Did I have insurance this year? My utility bills, water bills, the whole kit and caboodle. Add that up every month, right? And then I reimburse myself. Usually I do it as a contribution to my business at the end of the year, and then I take a distribution later. However, I tally up those home office expenses in my spreadsheet so I have the backup documentation. Where do those numbers come from? Well, they came from here. Well, where do those numbers come from? Okay, well, let's log into my UI bill. Let's log into my gas bill. Let's log into my mortgage statement. Where do they come from? It's variable, meaning that it needs to be consistent, documented, and there needs to be intentional setup, such as the accountable plan. Now, last but not least, strategy. This is where the actual planning happens. And guess what? Like we said, we can't do strategy without bookkeeping, and bookkeeping is the foundation. So all the strategic things that we can do for you, those are in more videos to come. But remember, we cannot do tax strategy without the actual systems in place. No systems, no strategy. No bookkeeping, no strategy. I should say no systems, no strategy, no bookkeeping, no booming tax savings. So keep our letters in tandem there. Okay, so now bookkeeping. Speaking of bookkeeping, bookkeeping equals bottleneck. And again, here's the hard truth. We can't do the tax strategy without the bookkeeping. Because guess what? Your bookkeeping is either late, it's messy, inconsistent, you have different categories, there's no reconciliations, etc. So if this is you, then guess what? Our write-off stack up here collapses. Those bricks are falling right off. Because guess what? We can't build a house without the foundation, right? So we can't build a house without the bookkeeping. So let's look at our good friends. We haven't talked about them in a while. We got Goofus and we got Gallant. Now Goofus and Gallant both have 150,000 of profit to play around with. However, Goofus has random expenses. He's got inconsistent categories, and he's got no system. He's got no QuickBooks Online. He's got no QuickBooks. He's got no set of books. Now Gallant he's got clean QuickBooks. He's very consistent and he's intentional. Now the intentional means that he's going to be able to get strategic, which equals a low tax bill. So let's be a Gallant, people. So in this case study, Goofus ended up paying about $30,000 in tax, and Gallant paid $10,000 in tax. So essentially, here's your cost benefit analysis here. That's a $20,000 tax savings. Which now, if we straight line this, $20,000 over 12 months, that's roughly $1,600 of tax savings every month. Roughly 400 tax savings a week. So that's the question you got to ask yourself. If you're a business owner, is this worth it to you? To be consistent, be intentional, strategize, work with your CPA. Is $20,000 annually worth it for you? Is the $1,600 a month worth it for you? Is the $400 a week worth it? Quick and dirty math. I know it's not. I'm going to see a freaking thing. Oh yeah, Mike from Ledgerly doesn't know how to do math. People, I'm going off the top of my head. Now, you know who can do math off the top of their head is my partner in crime, Andrew. So shout out to him. Me, I'm just the, I guess the looks behind the operation. But anyways, so let's get to the point where we're acting more like a Gallant, because I want to save $20,000 a year. So why don't you? So let's get intentional about this, because everyone at the end of the year is like, oh, don't worry. My CPA is going to take care of my bookkeeping. Don't worry. I'm in good shape. Okay. Well, your CPA is going to take care of bookkeeping for last year. We can't do strategy now. It's too late. And your CPA is going to charge you maybe $150 an hour for bookkeeping. That could have been done maybe $40 to $80 an hour for a good bookkeeper. Okay. So yeah, I see what you're saying now. That makes sense. Oh yeah, and my CPA is gonna fix all my problems and wave a magic wand. Oh yeah, that makes sense. No, that doesn't make any freaking sense. That does not work. You need to be intentional about it in the current year. Your CPA isn't going to wave a magic wand. We don't wave magic wands. We tell you, if you're completely honest, we'll tell you to some of our clients that we're very close with, no, that you're being an idiot. Don't do that. Or let's get with the program. Let's save some money. We're going to identify things. We're going to lead you to water, but we're not going to stick your head in the water if you don't want to drink it, right? So let's be intentional. We're not looking in the back mirror anymore. We got to look forward, people. Got to look forward. We got to be intentional. We need to grasp it, firmly grasp it, as Patrick would say. Firmly grasp it. Firmly grasp your business. Let's not suffocate it. Let's not pay an extra $20,000 if we don't need to, like freaking Gallant over here. I mean, freaking Goofus. Goofus. Let's take it. Let's run with it. Let's build our stack here. Let's bookkeeping, foundational, operational, let's get strategic. And then once you have this solid write-off stack per se, that's where we can start talking about the solo 401k, maybe the S Corp, maybe mega back to a Roth, maybe some real estate, maybe oil and gas, maybe your HSA, paying your kids, all these different things, because now we know your books and records are clean. now we can actually have faith that we're going to implement these strategies the right way for you. So if we're like our good friends down here, Goofus and Gallant, and we're profitable, we know we're profiting, but we feel like deductions are random, like Goofus, don't worry, they're fixable. We can go right over to the Gallant side. And that's what we help. We help business owners clean up their books, or even just set up books from the first place. Establish a good cadence for bookkeeping, come up with defensible write-offs, and ultimately get strategic. So if this is you, if you're Goofus and you want to get over to Gallant, or you're Gallant, but now you want to start talking strategy, let's talk. Let's do a tax plan. Let's create a cutting edge way that's going to keep more money in your pocket here, like Gallant here, 20,000 back in his pocket. Because tax savings don't just come from the write-offs. They come from establishing the right systems, the right cadence, and ultimately the right foundation. So I hope this video has been helpful, eye-opening, and you're ready to take your decisions as a business owner to the next level. We'll see you in the next one.